Welcome to the second eCap panel. I don't know how we could compete with the first one. I saw the first one, it was amazing. I don't have any better insights than that, but I'm just going to make a quick intro because I don't think anybody has any interest in what I have to say. But These people here are brilliant geniuses of our industry, and we're going to hear what they have to say. So the title of this panel is Hindsight is 2020. The object of this panel is to provide informative and new, fresh conversation on the healthcare landscape that we've experienced over the last 3 years. What are we to expect post-PDPM and into the future? And hopefully our esteemed panelists will shed light on the state of nursing homes in today's environment, and they will provide intriguing and provocative conversation for all of us to go back home and to think about. So nobody here really needs introduction. If you don't know who these people are, you probably should not be in this room. I'm Fred Friedman. Yeah, I figured that's the only guy who needs to be introduced. But we have the esteemed, what an honor it is to have Mr. George Hager, the CEO of Genesis Healthcare. George has over 25 years of experience in the healthcare industry, and prior to becoming the CEO of Genesis, he was also the executive vice president, and he was the chief financial officer, and he was responsible for all the corporate finance, information service, reimbursement, risk management. He knows everything that there is to know about this industry. Vikas Gupta was supposed to be sitting right there. Unfortunately, he had a family emergency, but now I guess the REITs are open target. And of course, we have Mr. Avi Rothner. Round of applause.
Thank you.
My childhood, and I wouldn't say childhood, but very close family friend, is very vocal, has many opinions on every spectrum. We fight about it almost on a daily basis. He founded Altitude in 2011. He has broad transactional experience. His directed purchases of over $400 million and executed deals with all manners of sellers, with REITs, with mom and pops, with regionals, super regional operators. So again, very, very knowledgeable in this field. Then we have, again, needs absolutely no introduction, Mr. Ari Dobkin, the managing director of Meridian Capital. He speaks for himself, as you will see shortly. He has close to 10 years in the industry, is an expert of a wide variety of financing types, including construction, mezz, bridge, balance sheet, asset-based loans. So we would call him the intermediary. And of course, my close and dearest friend, Mr. Erik Howard, Director of Healthcare Finance for CFG, also one of the best looking individuals in healthcare today.
Not saying much.
Not saying much, yeah.
Saying much.
No, well, Abby's also decent looking. He joined CFG in September of 24, responsible for the structuring and financing of almost every healthcare real estate transaction, and just an unbelievable asset, and what an honor it is to have him on our panel. So based on we had one initial eCap call. Again, Vikas was very vocal on that call, but we unfortunately will not be hearing any of his opinions now. But when we did that first initial call, this panel, unlike many of the other panels that I've watched, it seems that we have people who are not everyone here is on the same page. You know, we have people on the panel who are coming from every side of the spectrum. We have George and Avi, who are owners and operators, and then we have Erik, who is coming from the lending side, and of course Avi, the world's greatest broker, and maybe just the world's greatest person, period.
Not the best looking.
Yeah, sorry about that. Okay, question number one. So I'm just going to direct the first question to George. There's a lot of owners, a lot of mid-level operators in this room, and they want to hear insight as to what the future looks like, and also to review how the predictions of the past 2 years actually panned out. You know, a lot of us 2 years ago sent our financials for the homes that we were acquiring to Ari. They were in special focus. They were losing $10 million, and somehow he spinned out a pro forma that says we're going to be making $400,000 of DAR every week. How did that pan out? And really, we asked this question to you 2 years ago, George, what is the matziv? in healthcare today? What's the situation? Matzav means situation, for those of you who don't understand that.
Yeah, the matzah's definitely improving, no question about it. I would say if you look back 2 years, the industry was still challenged. We were experiencing consistent census declines that had persisted really since the initiation of a lot of the healthcare reform initiatives that drove utilization, especially skilled utilization, down in our space. So we saw declining census, we saw declining length of stay. Reimbursement wasn't keeping up with cost. And all those things were pointing to, negative outcomes, which the industry, for the most part, experienced. Combine that with really extraordinary leverage that had been deployed back immediately prior to and after the implementation of RUG 4, principally the OpCo-PropCo models done by the very large, public REITs, Welltower, Omega with Vicus, as well as, Ventas and HCP. And, that's a perfect storm, declining fundamentals, high leverage, and leverage that with the traditional REIT model that cost more every year, those fundamentals obviously had a very negative outcome on the industry. As we sit here today in 2020, we, Genesis, and I think most of the industry finally saw an inflection point on total census where we saw, for the first time in 5 years, growth in census. That happened in the fourth quarter of 18 and has continued through 19 and into 2020 as well. I think key for all of us is that number, and that fundamental is without a doubt improving. And when you look at the demographics, the demographics we believe are going to continue to drive demand. And you look at the average age of the infrastructure in the skilled nursing space at over 40 years, I think you're going to continue to see a decline in the number of beds operated. So the macro fundamentals, are going to work in our favor, this industry's favor from my point of view for the foreseeable future. We're just starting to see the early stages of the post-war birth rates, hopefully the early stages of the boomers beginning to come through our space. They come through our space later than the other parts of the senior housing world. Our average admission age is clearly north of 80, in many cases north of 85. You can do the math and get yourself back to, 1935, 1940, as that population is coming through. And demands will continue to grow, supply will continue to shrink. There's really very little economic feasibility in most markets in most states to build a new skilled nursing bed. You have constraint by CON law, and then you just have economic feasibility to build a duly certified building with a projection of north of 50% Medicaid in that building. The Medicaid systems do not lend themselves easily to funding and reimbursing today's cost per bed, which is anywhere from, on the very low end, $100,000 a bed to put a new bed in place. We're building our high-end power back centers at closer to $200,000 to $250,000 a bed. So I think supply continues to be constrained and decline, demand grows, and I think the thing we have to look forward to, hopefully, is more responsible Medicaid funding. And if the Medicaid systems keep pace with cost, I think the fundamentals for the industry.
I'm just going to jump in over here because we're talking about the demand surging, but at the same time, like in the last panel, we talked about managed care penetration and what it's done and how bad it will get. I know by us in Ohio, we're about 50-50 on the, on Med A versus HMOs, and it's seemingly getting worse before it gets better. I think maybe everybody is just going to end up in a managed care plan. Who knows? How are we going to scale that? And is the demand, the baby boomer demand, going to outweigh the shortened length of stays of HMOs? Avi?
Well, I want to actually jump back for a second to utilization and just point out that I think in our business we've been part of 5 kind of consolidations. So it's interesting. We're talking about increased utilization and metrics and length of stays declining, but our services are going to be needed. So I can name you 5 places where, we kind of, the little bighorn, right? We bought 3 buildings, made them into 2, 5 into 4. So it's kind of interesting to hear where there's good demographics and there's good markets, that there's definitely that growth. But I've seen other places where, we've talked about, there used to be, you can sell any building in X state, it's 20,000 a bed, it's 30,000 a bed. And I feel like in terms of utilization, I'm seeing people say, yeah, the floor for that building has changed. It's now 0. So close that building down in Corpus Christi, in Milwaukee, in wherever it is, in rural Nebraska, and just, let the patients go where they go.
We actually have had a lot of experience on the financing end as well, where one client's in this room right now, one's not, where they bought a portfolio in the Midwest in states that have very low occupancy rates, and they bought 10 plus buildings, 12 plus buildings, shut down 4 of them,
Right.
moved,
As part of the plan.
consolidated the residents, and they're crushing it in those facilities right now. So, and especially in states like Massachusetts, Wisconsin, I mean, you're just seeing a lot of closures. So I'm not sure how much of the increased occupancy that we're seeing is as much as because there's closures going on, just because people are struggling as much as they are, especially in low reimbursed Medicaid states, as much as it is the baby boomers coming in. And it's interesting to see that as some of these states slow down the closures, I mean, Wisconsin and Massachusetts basically came out and said, like, we have Ohio as well, right? We have a strategy that we want to take beds off the market and see the average occupancy in our states rise. It's interesting to see if the average occupancies that the remaining facilities are seeing are because of those efforts, the baby boomers, or a combination of both.
Right.
Here's a question that actually Avi asked me last night, and it's an interesting question. Today, how are deals getting done? It seems almost like the marketplace is going off market, and I think Ari has a lot to do with that and a lot to say about that. How do we get our hands on deals? How do we do business with people like Genesis?
Pay the broker.
What are you finding, Avi, in the marketplace?
So I think for the bigger companies, I've had these conversations. I've had this conversation with George, and for some of the companies, it's they're a public company, so there's shareholders, there's considerations, there's compliance. They're going to run a process, but I think for other people, I think that there's definitely a place for Blueprint. Everyone's still going to get paid, and it's fine. There's Blueprints and Slibs, and there's all those guys, and they can still make money, and I think the brokerage business has grown. But I also think that there are people who themselves are looking around the room and saying, I have 3 buildings in Pennsylvania, it's in this county, here are the logical people. Now, the good, and I've also seen brokers who self-select. They don't, send out to 600 people, they're sending out to the right 6 people. Now, I don't know how you grow in Pennsylvania if you're not in Pennsylvania, which is which is kind of the con to that process, but at the same time, it's quiet. I think there's an allure for some people to get something that's off market. They're gonna, it's got some sex appeal, and usually if I'm calling you, it's because I see you as a strategic value, right? You're in the collar counties, you're in the surrounding counties, you're my competitor, and so I'm making that call to you first. But I also think there's definitely, if there's going to be a public REIT that's going to sell, they can't just say to the shareholders, yeah, we met in some dark alley with some guy who wrote us a check. It's we went to the market, there was price discovery and all that kind of stuff to show that there was a process and compliance.
I actually disagree with Avi in the sense that
What else is new?
in the sense that I think that the market has seen value in almost not running a process. I think that there are certain price per bed expectations in certain states, especially based on recent transactions that we've seen in particular states. And sometimes you'll lose the interest of the people that are paying the most in those markets when they hear, I have to go through a process, I have to go through 1 round, 2nd round, 3rd round, show them all my financials and everything like that. And we've actually seen some of the more public companies realize more value that way, whether it's been through us, whether it's been their own direct efforts. And because of that, we actually see pricing metrics go up sometimes when you're not running a process versus the other way. Now, we've done it both ways, and we have experience on both sides, and we've seen it go both ways, but I think more recently, you're seeing the interest from the sellers to just go direct and go, like Avi said, like to a targeted market, as opposed to just blasting it out to 40 people in the market.
Right.
Yeah, I think that, and getting back, Freddie, to your original comment, which is what's kind of transpired in the industry over the last couple of years, and we'll talk about this obviously with PDPM in a minute, but I think what we've seen, and it's a little bit of where the market is with respect to sales, as George alluded to, is that we've seen really diseconomies of scale. Genesis has been part of that. Omega's been part of that. Many people in this room have benefited from that, which is just too big. I mean, I think one of the things that a lot of folks in this room and lenders and a lot of owners and operators have realized, and something that we kind of forgot over the years, is that healthcare is local. And a lot of you operate in a handful of states, and that there's that question of what's the right number. Is it 200? Is it 300? Probably not. I think we're seeing that. But it gets to what Avi noted, which is you've got various levels of sophistication, obviously, in the healthcare industry that's really evolved over the last 20 years. And as Avi noted, very large companies have to run a process. They have fiduciary obligations to owners and investors, et cetera. And so they're going to use RE, and they're going to use other intermediaries. But I think that a lot of people in this room have probably seen some success recognizing that they're focusing on a couple core states, and they're out there beating the bushes and getting off-market deals because they're talking to what we would refer to as mom and pops. And I think we're going to see a lot of that, probably over the next 12 to 18 months as the acquisition market remains robust, because I think PDPM is going to continue to be a challenge for some operators that may not have the clinical approach that a lot of you have, and they're going to look to go to market, and they're going to look to maybe exit. And so we've seen some of that over the past, again, 12 to 18 months, but I think we're going to continue to see that, and I think there's going to be more opportunities for off-market deals as these folks that have 1, 2 buildings look to exit.
George, how did PDPM pan out versus what you underwrote it in 2019, 2018?
It looks like, I don't know if people heard, the last panel, but we're pretty much in line with what we expected. We expected PDPM to be, marginally positive. I think that the big issue that we as an industry had to face with PDPM is the challenges of any changes operationally and keeping people focused on patient outcome. As Mark Parkinson said earlier, the president of HCA, there was a lot of discussion that therapy minutes provided to patients would decline precipitously, post-PDPM, that there would be an enormous growth in group and concurrent therapy. And I don't think Mark's seeing it around the industry, and we're not seeing it either. And there's no question, both PDPM and just the world we live in, which has now moved to, a value-based reimbursement system where outcomes and cost are clearly at the forefront as opposed to volume under the old reimbursement systems. We as an industry need to be focused on outcome, and we are. We use the modified Bartel index to measure patient outcomes for our discharge and our long-term care population, and we're seeing actually either stable or slightly improving outcomes post-PDPM, and that's the key metric for us. But I think overall, it'll be a positive for the industry. I actually think CMS got this one right. I think the implementation looks pretty close to what they expected. I know there's concern, as there was in 2011, that maybe it would be too good and there would be a take back as there was in 2012, which turned the industry upside down. And I don't see that from our perspective and the comments I'm hearing from Mark as well. So generally speaking, positive for the industry. It was a heavy lift, for everyone through the implementation process.
Are there any other major regulation changes that you expect coming our way? And something coming that a mid-sized operator should be knowing about today, and what's the best way to prepare for that?
Yeah, the regulations that you have to be, focused on. We think we're okay on the block grant issue. We as an industry have been carved out of block granting, but any issue that potentially negatively impacts, Medicaid funding and block grants on the table, looks like we're okay on that, but something you want to be aware of. And then the MFAR, legislation that we think most states that are currently getting waivers for their provider tax programs probably can get into compliance with that. But I would say the states that are in the like Indiana and Texas that have a unique, supplemental funding program, I think those programs are going to be challenged with that.
That was actually my next question.
I actually think, just to add to what George said, the inclusion of the SFF pending list has become an item that a lot of lenders have honed in on, and it's kind of ironic because any lender at any time could have looked at, what the compliance records have been and what the surveys look like, and ask themselves, could this go on the SFF? But there's never been like a set up list for it now. And now that there is, I find myself making the arguments like, hey, we know that this is a turnaround, and we always know that this could have gone on an SFF just because of the clinical histories over here. But because lenders can say, but it's on the list, it becomes slightly more challenging to kind of speak to that and make sure that you have to give the lenders slightly more comfort. In addition, on the UPL side, in Indiana, Texas, and Utah is also another big exposure state for UPL. We haven't quite seen where the lenders, at least on the lending side, is shaking out in terms of their valuations. I mean, we've spoken to lenders and appraisers where typically they've been anywhere to a 20 to a 22 cap on UPL EBITDA. They're suggesting that maybe they're on the high end of that now, or maybe even going up to like a 4x at like a 25 cap on UPL EBITDA. But it seems like no one. What?
Keep going.
You heard of her?
No, I had a call. No, it's a good question.
Yeah,
I had a call with an appraiser this week, and he said, so someone's in the middle of buying, and I'm not sure if it's anyone here, someone's in the middle of buying an Indiana building, you have stuff, what do you think? He said, it was at that 4 times, what is it now? I said, we never underwrote to UPL, we don't, everyone says there's a bank, and we haven't necessarily found the banks who are so ready, willing, and able. And he's like, well, maybe it's a 2 cap, maybe it's a 2x.
Yeah, I mean, we've historically have gotten lenders comfortable underwriting to 20 caps because that's what HUD essentially underwrites to usually, as long with other determining factors of what percentage of UPL is being represented in the overall EBITDA. I think we can still get pretty good value, much more than a 2x on UPL. I mean, it would be catastrophic to a state like Indiana. Indiana, I think, has the lowest or second to lowest reimbursement in the country. I think them and Texas kind of go back and forth. It would be catastrophic. 97% of the facilities in the state are enrolled into the program.
But if UPL and IGT go away, does that mean
A third of the buildings will be gone.
Yeah.
Does it mean that the rate is going to be cut by $60 or $50?
No, they might make it qualitative like Texas did, but at the federal level as opposed to the state level. They might do other things to it, and by the way, that might be a blessing in disguise, because right now the best you can hope for on a UPL underwrite, because it's not really based on anything, it's almost like a gift, is a 20 cap. Well, what if I cut your UPL by a third, but I say it's qualitative, so there's something to point to, and it should be just introduced into the regular, 13 to 12 and a half cap valuation that you would get on regular nursing home EBITDA. You can actually end up coming out ahead. So it's interesting to see what's going to happen.
I see Erik's getting a little bit nervous here when we're talking about UPL and all of his assets in Texas. But how are banks dealing with that? How are banks dealing with these types of news like block rents? How are they? I've heard one bank tell me that they do a cash flow sweep if they're on the non-UPL EBITDA. They're doing certain cash flow sweeps, or they're if there's any trip of anything, then they just they take all the non-UPL EBITDA and they amortize down the loan. What's CFG doing? What are banks doing in this environment?
Well, I think it gets back to kind of underwriting 101, which is, you have to take a holistic approach. And so depending on what the exposure is, both from the bank's perspective as well as the operator's perspective. So if you're dealing with an owner-operator who's got all their assets in Indiana, as an example, and has no other supplemental approach to their income to support the loan, then obviously you're going to take a little bit of a different kind of perspective with respect to that. We're a little bit more cautious or less cautious, if you will, than maybe most other lenders in that just we're relationship oriented. We're taking a longer perspective, and we'll work through and dig through that with our owners and operators in terms of understanding that. So as Ari noted, while historically you may be at anywhere from 3 to 4 times on UPL as an example, and then there's a question mark in terms of what do we do going forward. Most banks will take a wait and see approach, and so we're doing that a little bit, but again, just it's more relationship driven, which is if you can underwrite the asset, you can underwrite the company, which we're doing. We're taking steps to do that as well in terms of not just being so asset specific and really looking at the organization, the sponsors, and their overall wherewithal across the space.
This is a question for everybody here. Avi or Ari, Erik, how do you guys assess a new operator? Genesis is obviously an old operator, so this is not necessarily a question for Genesis. How do you assess a new operator, and how do you assess an operator with a mixed history, where he's had some success, but he's had some epic fails? Where do you underwrite them, and what are like immediate red flags for a bank, for a mini REIT like Avi? Feel free, any of you, to take this.
I think it's become interesting because since we're an intermediary, we can sometimes take the approach that, well, we're kind of ambivalent as long as we can get it, past the banks. But, what we've always been cognizant of is that, at the end of the day,
Conversations, and for some people, it's just, it's an eye-opening conversation, and I think the deals sometimes, the people think the deals change for that, and I think it's more, this is the way.
Anticipated correctly.
That's right. You just weren't right. You just thought literally, bring the $2 million for this $10 million deal, and that's all the money that will be needed. There's no closing costs. There's no nothing, and that's not a realistic approach.
Let's talk about the bank-operator relationship. Erik, is it too hands-on?
I didn't know banks operated.
They're your partners.
Right, they're your partners. Is it too hands-on? Should banks be more involved? Should they be calling you every time there's a census drop-off for 2 weeks? What's the approach for the banks today, especially now with bridge lenders and mezz lenders and B, C, D, and E pieces? There's a lot of people to answer to and a lot of covenants to be met. Not so much for you, Avi. So, conventional person, yeah.
Now, I think that there has to be a good relationship, obviously, between the banks and the operators. Even with a landlord-tenant relationship where the landlord is your borrower, understanding, obviously, what drives this industry. It's become a lot more sophisticated, as we've talked about over the last 5 to 10, 15 years. Interestingly, when you look at the lending landscape today, and just a data point for everyone, if you rewind 5, 10 years ago, many of the lenders that are in the space today were not in the space then. And so in terms of a cycle, maybe necessarily haven't even seen one. And so that becomes extremely important and incumbent on owners and operators and borrowers to really understand what that lending relationship is. As Freddy notes, there are lenders out there that have knee-jerk reactions, that want to manage census, that want to make sure that they're following very closely. I think we all know and understand in the room that, as George alluded to, I mean, there's headwinds and tailwinds back and forth with respect to occupancy, with respect to Med A, lengths of stay, et cetera. And so you have to understand at the core what's driving the facilities, what's driving profitability, and how those operators get there. As Avi noted, you've got to have a good thesis in terms of your approach. You've got to do business with good people. Banks, I'm sure that you all would appreciate that are in your business day in and day out, can be challenging. And you want to do what you do. And so, I mean, that's generally our approach. Well, watch, we understand the drivers of the industry, we understand the drivers of your profitability. We want you to do what you do, which is...
I want to hear two sides of the spectrum here, and I'm going to hear one from Avi, I'm sure I'll hear one from Ari. The old line of thinking was always, direct with the lender, and the relationship was straight. I know Avi knows every bank from here.
He thinks he does.
Yeah.
Yeah.
Till Oklahoma, every local bank. What's the advantages of just doing it yourself versus doing it through an intermediary?
So first of all, I'll jump on what Erik said, which is, number one, that's maybe your approach, but I, as the customer, I don't always know that in advance. Am I going to get the lender with the light touch or the heavy touch? And the answer is, you think it's your property, but it's their money, so congratulations, you now have a partner. Maybe the partner is a silent partner, maybe they're less silent. Certainly, if everything goes well, that's the best insurance policy you have to not having to have that regular call. But if it's not, then you find out what kind of lender you're dealing with. Now, on the direct side, I would have actually said, if Vikas was here, I actually was going to defend him. I think everybody here should know, and everyone out there should actually know, like, what do you do? What's your skill set? What do you work on? There are people who are great turnaround artists. There are operators I would give a building to with 30 Medicare who can make it 40 Medicare. And there are other guys who are just lower cost. I mean this in a bad way. They're Medicaid, lower cost kinds of guys. So I have relationships with lenders, but if I'm a guy with 2 buildings, I don't know the universe of lenders. I don't know what's out there. Ari's done more deals this week than the two facility operator. So by all means, and by the way, I've had a conversation with Ari and other intermediaries, and I've said, show me value. And those who have gotten, we've gotten loans done, and that's great. We've found on our own that we're able to do it. But if you're an operator and you want to be, working on your therapy costs, or you want to be working on your census, by all means, I think Ari's a great choice, among others.
Ari, how can you be of help to someone like Avi?
I think.
And bring value.
I think Avi is fundamentally flawed on this one. Not just on this question, just no. Listen, I've heard the perspective that Avi's given many, many times. I could tell you that over the last 3 years, our numbers have jumped from, on the representation side, from 1.1 billion to 1.6 to 2.8 last year. And I could tell you this, the drivers, as much as the bread and butter of what we do is the regionally based operators that are not doing these huge $200 million institutional deals. But I can also tell you that we didn't grow by over $1 billion last year because of onesie twosies.
Yeah, but squeeze data enough and you'll scream
There are a lot
however
of
you want it to.
sophisticated people out there, Avi, that are just as smart as you, that see value in us, and there's a reason for it. So, I mean,
I wasn't clapping.
Ralph's
I'm
not
smart.
Ralph's not here. Don't. No,
right, he's right there.
Ralph is here.
Ralph, can we rediscuss the splits?
No, that's the thing. But I can argue that there are other people who haven't used intermediaries. To be clear, intermediaries are a valuable service, and I think I've said it. But we've had conversations, and can you provide this, whatever this is? And if the answer is yes, and you're better suited to do it, by all means.
The best way I've always told people is that people have to know how to use me. And when someone comes to me and says, hey, here's one lender, I'm going to 30, and see if you can beat them, no, I'm absolutely of no use to me, of you. But if I come to you and say, let me run a process for you properly, I promise you that you'll see the value at the end of it.
Erik, on the bank side, if you could just weigh in here.
Sure.
We've heard what Avi and Ari have to say. What do you think?
I will say, in full disclosure, we do
Without being politically correct, Ari.
and we do
Give us the real
a lot of
answer.
business with Ari.
I'm like kind of like this right now,
There is value on both sides, and as everyone's noted, it's not a paradigm that works for everyone. The one thing, candidly, and that you would all, I'm sure, appreciate, and Ari does a great job on this, and it can work well for everyone in this room, generally, if this is what you want, which is leverage and pricing. So you create an open market in terms of getting you the best deal. That's fantastic for you. As noted, though, and Avi kind of talked about it briefly, which is it's very front-end loaded, if you will, which is execution and what's the best execution. There haven't been that many troubled deals, which is great, knock on wood, for all of you and all the success in the room. That's an intangible and unknown as you go into a process that may not be able to develop a relationship, as Freddy noted, or that Avi noted, with a lender, which is how do they react when they're your silent partner? And I can tell you that that's invaluable to pricing, because the cost that you would save on the front is unfortunately in a lot of cases made up in spades. If any of you have dealt with that on the back end when you don't have the right partner.
I can probably have 10 people in this audience raise their hands and tell you that I have advised clients in this room to take more expensive deals and less levered deals because I could read the tea leaves that they're going to need a more flexible lender or a lender that's going to be for them down the line. So again, I fundamentally disagree that I'm all about leverage and pricing. It's not true. I'm looking at people in this audience that I know in probably the last 4 weeks and they question me, like, why are you telling me to take a more expensive deal? And the answer is because it's not just about leverage and pricing. It's about creating the right relationships. We're matchmakers at the end of the day. We need, if there's an issue in 2 years from now on the loan, the lender's calling me, and they have. And you know what? We've stood by their side. We have done representations for lenders in workouts that we haven't represented. We've done representations and stood by lenders' side for things that we did represent. And so far, knock on wood, we have never had a deal that there were issues, and everyone's always going to have issues, but we've never had a lender that we represented on a deal that has taken a haircut on a deal. And we're very proud of that, and we take a lot of pride in taking that.
I feel that's a clapping moment.
It's
Basically, listen to Ari, and he'll give you the guidance of where to go to. George, we all just read, I assume everybody here read the article this week in Skilled Nursing News about Genesis' new model, which is, taking their national operations onto a more local level. So, A, what are the advantages? I know there are obvious advantages, but what are the advantages and disadvantages? And B, how does one go about getting in with an operator like Genesis, who's a mid-sized regional operator? Can we get your cell phone number? Or,
Ari's got that.
Like, how do we
Don't
go?
call me for it. I won't give it out. That's a test.
I described that transaction, and what talked about here is the transaction we just did in a joint venture structure in 3 states, California, Washington, and Nevada. It was an innovative model, and it wasn't necessarily an issue of, do we want to regionalize or localize operations everywhere? But when we looked across our 26 states that we operated in, those 3 states were relatively new states for Genesis through the acquisitions of Sun Health and Skilled. And clearly our performance, both financially and clinically, was not at the standard that we were looking for and that we achieved in most of our core markets in the Mid-Atlantic and the northeastern part of the country. So as we looked at our options, your options were to exit or try something that was innovative, which is what we did. And, we brought in a local, highly qualified operator in those states with strong experience. And we combined that, and the thinking was combine that with the strength, the infrastructure, the back office, the purchasing power, and all of the other ancillary benefits that Genesis brings to the table, whether it's the ACO, our therapy operations, clearly our purchasing power, our technology platform. So those infrastructure items do not need to be recreated or reinvented. I think it's an interesting model for us. The early signs are very, very encouraging. We like the model. Are we going to do it everywhere? No. But there are certain states, if I look at the biggest disadvantage of our size and our scale, it's not that we can't operate locally. We can operate locally very well through the regionalization of our operating infrastructure, which is how we built the company over the last 30 years. But with scale, you have a very big target on your back. Whether it's the plaintiff's bar, the class action bar, the regulatory bodies in many of our states will focus on the larger, for-profit, public, high-profile operators. And, getting that target off your back is a big advantage. And, one of the thoughts here, as you think about that model, we are not in the operating business now in California, Washington, and Nevada. Those has all been debranded. They are not Genesis facilities. They're not Genesis policies and procedures. We do not make operating decisions, in the true day-to-day operations of the buildings. Great model. As I said, not going to be applied in every state, but there are some markets, when you think about there's some bad GLPL markets. We can all name the states. Kentucky, West Virginia, New Mexico, New Jersey and Pennsylvania. Those are the types of states where you can think about maybe deploying a different model. I'm not saying we're going down that path in any of those states.
Wait. 30 calls after this.
No, I want to ask a different question, because you started with the purchasing, you started with the benefits for 30 seconds, and then it's been 3 minutes about the GLPO. So is this an insurance, I don't want to say end around, but that's which is, by the way, a great answer, but
No, in this case, we did not operate those buildings in those markets effectively. And what we've seen, we've been in this partnership through an administrative service agreement since April. The improvement on all fronts, census, operating cost, agency, outcomes, have all improved significantly. We just did not operate well, especially in the states of California and Washington. And the reason to do that deal was to improve outcomes, improve operating performance. You get tertiary benefits or secondary benefits on the cost side for things like GLPL, but you wouldn't do that model just because of
Avi,
GLPL.
it's always been, I don't know always, but has always been the philosophy, as far as I know, of you and your dad, of sticking with a local operator who has a penetration in a very specific market and taking risks with young operators who don't necessarily have any history, but have the drive and motivation. So I feel like this is definitely up your alley, and Genesis moving, not that they're doing this on a global scale, but moving to a more local level. Can you talk about some of your experience?
well, first of all, it goes back to one of the things I said about everybody on the panel, and just know yourself. Am I the best guy to buy a $2 million asset? Unless there's some huge strategic value for me, it's not my thing. But there are people here who are looking for their first deal, and it is. You're talking about markets. It's obvious. You're saying we've had this conversation. You guys are in the Northeast. Don't mess with Genesis. But California, whether it's because you guys are far away, or however it's happened and developed, or because it wasn't our organic market, it was an acquisition. Whatever you want to say, that was a weakness or a lesser strength. So for us, it's understanding the operator, understanding their plan, understanding what do they do, how do they do it, and what are they going to do. Because one of the things that we do, one of the first things that we're going to do is we're going to go to a lending partner, whether through an intermediary or direct, and if the guy just, I've always said the pro formas, they always look nice and pretty and they match up, but I need to understand, if a guy's going to talk about 22% margins in a universe of 15% margins, I'm really going to want to understand how he or she is going to get there. And so
I'm just going to go back to the lender side for a second. I know and this is actually another Avi question. Me and Avi spoke once or twice before the panel, but there's a lot of many times there's extreme pressure to get a deal closed in a timely fashion, and a lot of times you're going to hear, okay, it's February 19th, we need a 3-1 close, otherwise we have a TOE and the deal's blowing up.
Did you talk to Ari about that too?
My favorite word is ASAP. When does the need close? ASAP.
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 So how do banks manage those timelines, and how does Ari, somebody like you, push those timelines and make them happen?
I mean, sometimes borrowers can get a little chicken little, the sky is falling, and do you really need to close in 45 days, or can you take a little bit more time and run a regular process? So I think some of it is education to the borrower, saying if you don't need the time, don't push it, because something's going to fall through the cracks, or you're going to have less time to negotiate loan docs or something like that. But I think part of where the advisory work comes into play with us is that if there really is a TOE, and this is one of the times where we go to someone and say, pay the extra 50 basis points to have the certainty, so you don't have to take syndication risk, so you don't have a lender that might crap out on you. And I think that's where a lot of the education and our market knowledge of who can you rely on in tight timeframes and who you can't really comes into play.
Erik, we've all heard war stories about 100% financing and deals that have happened that way. How does one go about getting 100% financing?
Call Meridian.
They should ask you. You were able to get it. So there's a lot of structure that goes around it. We've been able to provide 100%, and in some cases even a little bit more.
104.
104% financing from time to time. And so there's unique situations where that makes sense. You've got a lease that's in place with a trapped landlord. You've got a fixed rate purchase price, which I know a number of folks in here have negotiated. You've created value on the operations. And so in those cases, some banks that have the flexibility and the creativity are able to provide proceeds that are in excess of a purchase price. and 100% finance, transactions.
CFG, 100% financing. Speak to Ari. If there's any questions from the audience, now is the time. Joel, you said you had a question? A burning issue that you had? No, nothing? Nathan? Have I said it all? Does anybody have any questions? I saw a hand being raised. Feel free to ask, because now is the time. No further questions?
Your Honor.
Your Honor. I should have asked somebody to prepare a question. That would have been smart beforehand. Put somebody out there. Okay, just to wrap this up, one piece of advice that you would like the audience... Ralph, what's your question?
Very good.
You're brilliant.
Excuse me. I think now is a good time to mention that Freddy's mom is actually here in the second row.
My biggest fan.
That's true.
Do you know how many people Freddy has been able to get married and make them go into semis instead of private rooms in his facilities because of his matchmaking abilities? It was always a census play.
Consolidating. Yeah. Anyway, one piece of advice from each and everyone. I'm going to start with George. That the audience walk away. The mid-level operator or the young operator who's just trying to break into the business. If you have one piece of advice that you can give them, what would that be?
I'll be focused on outcomes. At the end of the day, if you produce a good outcome for your patients, you'll be successful. But when I look at the failures that we've seen, and there are a number of them in this industry, I would say many of them were capital structure issues from day one that couldn't have been solved. It's just an imprudent and non-sustainable capital structure out of the gate. So I would say be conservative in your underwriting. Put some equity, maybe more than you want, into the transaction, and be focused on outcomes. So good underwriting, conservative capital structure, focus on outcomes, you'll be successful.
Avi?
Like a good superhero movie, know your origin story. So if I'm going to do a deal, I don't have it. Ari, I don't have any money. I need to find an operating partner, but I am an expense guru. I'm a census guy. I know Southwest Ohio, whatever my story is. Work that story, because that's how you're going to get things done. And yes, I might have to pay more on the first deal, or I might have to partner with somebody, but because I'm going to use whatever my superhero skill is, that's what's going to get me where I need to go.
I would say that surround yourself with people that you trust, that can give you great advice and give you great leadership, and surround yourself with good people. I have my underwriting team here in the audience today. I have my partner just walked out. But Ari, Josh, Matt, Tim, Ralph, and Yoni have been tremendous in giving us great advice and great leadership. My first day on the job, just so you know, my first day on the job was starting out like a lot of the young guys over here. Is this me? And we knew nothing about healthcare. Our first day on the job was Los Angeles Regional NIC. We walked in, we said, we do financing. Someone says, well, what are you seeing in the market? Our answer was, we do financing. And we've come a long way since then, and I credit that to the people around me and the people that have given me guidance. So don't pretend you know too much. Take the advice.
Erik?
I would say it's all about relationships, and a little bit what Ari noted, which is choose your partners wisely, and that's both on the operating side, your landlord partners, your lending partners, and do the right thing. It seems overly simplistic. We all talk about care. It's all about the resident. If you provide good care and your client, or you're focused on the resident, good things happen. I think a lot of you probably have seen that, and again, it seems really simplistic that when you put capital into your buildings and when you take care of residents and you have good quality outcomes, as George, you're successful. And when you do the right thing, when you have good partners, when you do what you say you're going to do in relationships, irrespective of which way they go. That's what I would say to.
Before we stop, I just want to give a shout out to Freddy. He spent a lot of time on this and did an excellent job. Thanks very much.
Thank you, everybody.